The first thing I do when I get onto the stage is to turn off my cell phone. And I would encourage you all to do the same. If I can figure out how to switch off my phone. Okay, good afternoon again. My name is Kishore Mahbubani. I'm the Dean of the Kuan Yew School of Public Policy. It gives me great pleasure to welcome you to this distinguished public lecture by Mr. Robert Kimmitt on the US and the world beyond the financial crisis. I will make 3 brief points in my introduction. The first point is, of course, about the current financial crisis. Bob told me he'll speak about the current crisis and also beyond the crisis too. And as we know, the current crisis is a remarkable one. One of our board members, Paul Volcker, has said, and I quote, he calls it the mother of all crises. I guess he's invoking the spirit of Saddam Hussein here. And he has said that the modern financial system has failed the test of the marketplace. And as you know, we meet at a remarkable moment of world history because tomorrow, within 24 hours, the G20 is meeting. And you can see from the amount of press reports coming out that even the G20 is struggling to find a solution to this crisis. And in this respect, we're very privileged to have Bob here to address us. The second point I was going to make is about the US Treasury, where Bob just came from. And as you know, the US Treasury, I'm not giving a big secret away, is one of the most powerful institutions in the world. It was established by an act of Congress in 1789 to manage government revenue. But today, the U.S. Treasury undertakes a wide array of complex tasks, which includes managing federal finance, collecting taxes, duties and monies paid to and due to the U.S., and paying all bills of the U.S., producing all currency and coinage, managing government accounts and the United States public debt, supervising national banks, advising the Congress on domestic and international financial, monetary, economic, trade, and tax policy. In short, the U.S. Treasury does a hell of a lot, and Bob Kimmitt, having just stepped down as the Deputy Secretary, can tell us quite a bit about what it does too. Finally, a word about the Speaker. I can tell you that he's had a truly distinguished career in public service. It began a long time ago when he graduated from West Point in '69, served in the military, served in the National Security Council, and then went on to work in many places. And I won't, Bob, if you don't mind, I won't read all the things that you've done, but I want to mention that from 1989 to 1991, Bob Kimmitt was Under Secretary of State for Political Affairs at a very crucial moment in world history. As you know, the Cold War had ended then, Tiananmen happened, and Bob was then at the center of all the action. In fact, that was the first time when I heard of Bob, because James Baker was then the Secretary of State, and all the press reports were about these 3 brilliant young men who was working with James Baker, Bob Zoellick, Bob Gallucci, and Bob Kimmitt. And all 3 have done remarkably well in their careers, and we are glad that Bob is here with us today. As a result of his service, President George H.W. Bush presented him with the Presidential Citizens Medal, which is the nation's second highest civilian award. After that, he served as U.S. Ambassador to Germany and was awarded the U.S. Defense Department's Distinguished Public Service Award, as well as Germany's highest honor, the Order of Merit. And of course, as you all know, from 2005 to 2009, he's been serving as Deputy Secretary of the U.S. Treasury at a very crucial and important point in the history of the United States. So we are very privileged to have him here to address us on a major topic. He'll speak for about 25 to 30 minutes, and after that we'll have a Q&A. And he told me he's ready to answer any questions you may have. So please be ready with your questions. So Bob, over to you, please.
Thank you, Kishore, for that kind and overly generous introduction. Moreover, I'd like to thank you for the invitation of the Lee Kuan Yew School of Public Policy to visit Singapore and join with all of you today. Kishore and I met through a mutual friend during Kishore's outstanding service as Singapore's permanent representative to the United Nations. We've stayed in touch since then in Washington, in New York, in Davos, and now during my first visit to Singapore. I'm always greatly informed by our interaction, including the hour we spent together earlier today. It was also a great pleasure to learn that my friend and former colleague Klaus Regling is here. Klaus and I first got to know each other when I was serving as an American ambassador, and Klaus was serving in the Ministry of Finance in Bonn. My service as the first American ambassador, posted in over 50 years to a united Germany, taught me many lessons about cultural differences among nations and peoples. My very wise predecessor gave me only one bit of advice before I left for Germany. Bobby said, "Never underestimate how important speeches are for the Germans. They love to give speeches, listen to speeches, and analyze speeches far more than we in the United States." Ambassador Walter spoke once for 40 minutes to a distinguished group like that assembled here this evening, sat down rather pleased with himself, only to have his host stand up and say, "Mr. Ambassador, thank you for those interesting remarks. If you ever have time to give a real speech, please come back and see us again." Well, if 40 minutes is where a real speech starts, as Kishore promised, you will get from me today only remarks, because both during my time in Germany and afterward, I decided that I was always going to try to leave as much time for questions as I took during the presentation. We gather today, as Kishore said, in the midst of exceptional stress in the global economy. The International Monetary Fund expects global growth this year to be at its lowest level since the Second World War, and trade flows are expected to decline by almost 10%, the greatest decline in a quarter century. Although some countries and regions, including Asia, are performing relatively better, no economy has been spared the effects of this dramatic slowdown. I would like to discuss what brought us to this point and what steps have been taken and are being taken to address the current stress. I would then like to discuss issues that should be considered now to prepare for the recovery that will come, and it will come. And lastly, I would like to conclude with some thoughts about the need for a new global financial architecture to help address current and future concerns and opportunities. Let's talk first about the root causes of the market turmoil and how did we get to this point. In truth, the imbalances that caused the crisis built over time, and the absence of a serious recession over more than 2 decades bred complacency. The story thus begins with a long period of benign economic conditions, marked by low interest rates, low inflation, and less volatile asset markets, leading many to ignore the risk half of the risk-reward equation that is at the heart of financial markets. Investors around the world, who in preceding years had enjoyed above historical returns on most assets, continued reaching for ever higher gains. In response, the financial services industry created a variety of complicated new financial products to meet this demand, and regulators and investors alike showed a growing complacency toward risk. These factors, blended together, created underlying conditions ripe for instability. The imbalance between risk and reward was most evident in the U.S. housing market, where lenders significantly loosened credit standards, particularly for a new generation of adjustable rate mortgages. In the summer of 2007, these vulnerabilities in our financial system became clear, as looser credit standards in the housing market and an end to rapid home price appreciation led to a significant rise in delinquent mortgages. This in turn contributed to immediate and unexpected losses for investors and a reconsideration of the risk-reward relationship, first in housing and soon after across all asset classes. As we all know now well, shaken investor confidence in housing assets had a domino effect throughout world markets, ratcheting up demand for cash and liquidity and curtailing the pace of the new lending and investment necessary for continued growth. Since August of 2007, when the cracks in the global financial system first began to appear, U.S. policymakers have responded both at home and abroad. First, recognizing the risk of the housing downturn, the U.S. government implemented a $150 billion stimulus package and launched a number of initiatives to mitigate the impact on the real economy and help preserve home ownership. In the second phase, as instability in the financial services sector grew, policymakers acted on a case-by-case basis, as, for example, when the Federal Reserve facilitated the sale of Bear Stearns. Fannie Mae and Freddie Mac were placed in conservatorship or government control so the regulator could put in place business changes to restore the capital of the enterprises, and Treasury could provide a firm commitment to pay agency debt holders. These moves were intended to prevent the collapse of the financial system that could have resulted from a sudden failure of these firms. In each of these cases, policymakers were trying to strike a careful balance between promoting market discipline and mitigating systemic risk, holding investors and management teams accountable and protecting consumers from collateral damage. This is a very difficult balance to strike. Despite the government's support for Fannie Mae and Freddie Mac and the resolution of destabilizing situations ranging from American International Group, AIG, to Wachovia to Lehman Brothers, investors became increasingly concerned over the possibility of other failing financial institutions. This resulted in a freezing of credit markets and an unwillingness of investors around the world to assume counterparty risk. Given this fragile environment, U.S. authorities moved to a third phase of action in early October 2008, taking decisive and comprehensive steps to stabilize the markets and address the underlying sources of uncertainty. First, authorities in the U.S. and around the world took steps to improve liquidity. In addition to dramatic and unprecedented decreases in interest rates, the Federal Reserve launched initiatives to increase access to funding for businesses in all sectors of our economy and improve money market liquidity. Second, with the support of Treasury and the Federal Reserve, the Federal Deposit Insurance Company launched a program to guarantee newly issued debt of participating FDIC-insured institutions for up to 3 years, as well as deposits in non-interest-bearing deposit transaction accounts. These actions have provided confidence to the banking system by mitigating counterparty risk and averting destabilizing flows of capital between U.S. banks. Simply said, this action was meant to prevent a run on our banks, which seemed very plausible last October. Finally, and perhaps most important, Treasury provided much-needed capital to address one of the root causes of the current stress in our financial system, the ongoing housing correction and the consequent buildup of illiquid mortgage-related assets. These troubled assets remain frozen on the balance sheets of banks and other financial institutions, eating away at their capital and constraining the flow of new lending. Under authority granted by Congress in early October of last year, authority that is commonly referred to as the TARP, or Troubled Asset Relief Program, Treasury designed a capital injection plan through which 9 major financial institutions, comprising more than 50% of U.S. deposits and assets, received a combined $125 billion of capital in return for granting the U.S. government minority stakes. An additional $125 billion was committed for other banks across the country, and a portion of this second $125 billion was also subsequently used for a second infusion of capital for Citigroup and Bank of America, 2 institutions that continued to struggle as a consequence of particularly troubled mortgage-related assets on their balance sheets. We saw some signs of progress from these actions. Short-term funding spreads tightened, and funding maturities started lengthening. Money markets and the commercial paper market showed signs of improvement, and credit default swaps, or the insurance premiums on the potential risk of default, narrowed dramatically. Yet significant challenges remain. Risk spreads remain high, and lending standards have grown more restrictive. U.S. financial institutions and the global banking system more broadly remain fragile. The U.S. and the global economies are slowing, with every indication the coming quarters in the U.S., Europe, and other major economies will be weak. President Obama and his team have made economic recovery their highest priority. Largely on party lines, the Congress in February passed a $787 billion stimulus bill that is designed to create 3 to 4 million new jobs by the end of 2010. Also in February, Treasury Secretary Tim Geithner unveiled a framework of initiatives to address 4 problems at the heart of the financial crisis: falling home prices, frozen credit markets, weakened bank capital positions, and bank balance sheets weighed down by mortgage-related assets. He launched a home affordability program to stabilize the housing market by keeping mortgage rates low and ensuring that as many as 9 million responsible homeowners can refinance into affordable mortgages or modify at-risk loans. As a result of these actions and those by the Federal Reserve, 15- and 30-year mortgage rates have fallen to near record lows, and U.S. housing starts and sales were unexpectedly strong in March. Last week, Secretary Geithner announced a public-private investment program to buy some of the mortgage-related assets that are clogging the financial system and thereby restart the private market for these assets. Under this investment program, the government will provide financing to investors on a competitive basis for them to purchase the assets. The purchases will be structured so that investors share the risk of loss while taxpayers share the eventual profits. Treasury intends that private investors, rather than the government, determine the prices to be paid for the assets, believing the combination of public and private funds will be enough to generate an immediate $500 billion in purchasing power and over time up to $1 trillion in purchasing power. The combination of government capital assistance and the asset purchase program will help banks clean up their balance sheets so they can go back to doing what they must do in order to sustain recovery, and that is to lend. One of the key lessons of the current crisis is that destabilizing dangers can come from financial institutions besides banks. But the current U.S. bank regulatory system provides few ways to deal with these risks. Secretary Geithner also last week testified before Congress about the need for legislation that would give the government the authority to help a non-bank firm, for example, an insurance firm, whose troubles could pose such a systemic threat, but also the authority to become its conservator or receiver with the power to protect the financial system against instability. Lastly, building on the blueprint for regulatory reform laid out last spring by the Bush administration, Secretary Geithner last week said the Obama administration was working on a comprehensive framework for regulatory reform that will cover 4 broad areas: systemic risk, consumer and investor protection, eliminating gaps in our regulatory structure, and international coordination. He then laid out the key elements of his plan to address the most serious concern, systemic risk. First, to establish a new single entity with responsibility for systemic stability over the major institutions and critical payment and settlement systems and activities. Second, to establish and enforce substantially more conservative capital requirements for institutions that pose potential risk to the stability of the financial system, requirements that are designed to dampen rather than amplify financial cycles. Third, to require that leveraged private investment funds, such as hedge funds, with assets under management over a certain threshold, register with the Securities and Exchange Commission to provide greater capacity for protecting investors and market integrity. Fourth, to establish a comprehensive framework of oversight, protections, and disclosure for the over-the-counter derivatives market, moving the standardized parts of those markets to a central clearinghouse and encouraging further use of exchange-traded instruments. Fifth, the SEC should develop strong requirements for money market funds to reduce the risk of rapid withdrawals of funds that could pose greater risks to market functioning. And sixth, to establish a stronger resolution mechanism that gives the government tools to protect the financial system and the broader economy from the potential failure of large, complex financial institutions. These steps represent a major step forward in the United States. However, we know that risk respects no borders, and the U.S. plan will not focus solely on financial regulations in the United States, but, with the help of other interested nations and strengthened international bodies, on stronger standards globally as well. As Kishore Mahbubani said, tomorrow President Obama and other leaders will gather in London for the G20 meeting to build support for a global system to make financial reforms, strengthen the International Monetary Fund, and spur recovery. To match the development of increasingly global markets, the United States knows that global standards for financial regulation must be closely coordinated and consistent with the higher standards to be implemented in the United States. The Financial Stability Forum, which, like the G20, was created after the Asian financial crisis of the late 1990s, and in which Singapore is a key participant, has played an essential role in the global effort, working with the world's standard-setting bodies to study the underlying causes of the crisis and address these weaknesses. Much progress is being made to enhance sound regulation, strengthen transparency, and reinforce international collaboration. The United States has begun to work with international colleagues to reform and strengthen the Financial Stability Forum so that it can play a more effective role alongside the original Bretton Woods institutions in strengthening the financial system. Agreement has already been reached to expand the FSF membership to include all G20 countries, giving it a stronger mandate for promoting more robust standards consistent with the principles mentioned earlier, and working with the IMF and World Bank to monitor the implementation of those standards. In addition, the United States tomorrow intends to launch a new initiative to address prudential supervision, tax havens, and money laundering issues in weakly regulated jurisdictions. President Obama will underscore in London tomorrow at the Leaders' Summit the imperative of raising standards across the globe and encouraging a race to the top rather than to the bottom. Even as steps are taken in the United States and globally to strengthen the financial system and spur economic recovery, we must begin now to think beyond the present challenges to the recovery that will come. And for that recovery to be strong and sustained, we must resist the urge to retreat now into protectionism. Regrettably, we are seeing precisely that trend develop, including many of the same G20 countries who pledged just last November not to take such protectionist steps. When one hears the term protectionism, thoughts first turn to classic trade protectionism. And such protectionism, dating from the days of Smoot-Hawley tariffs in the United States 80 years ago, can both rapidly decelerate growth and significantly impede recovery. Speaking candidly, given that the global trading community could not deliver success in the Doha round even before the financial crisis began, I am concerned about the prospects for advancing open trade in the years ahead. I am heartened by the calls by Gordon Brown and the World Bank for new trade finance mechanisms, but these new funds must be matched by a commitment to enhancing global trade. Trade between partners like Singapore and the United States, based on bilateral free trade agreements, will continue to grow, but even that trade will be constrained by the global slowdown in the near term and affected by protectionist trends away from the bilateral relationship in the long term. It is incumbent on both our countries, in forums we share and those we do not, to be leaders in the fight against protectionism and in favor of free trade. One reason trade is such a difficult topic is that economists as well as politicians are split almost evenly on whether the effects on jobs in a free trade environment is positive or negative. And any politician's first three economic priorities are jobs, jobs, and jobs. Fortunately, in another crucial area, the free flow of capital across borders based on open investment policies, the jobs effect is seen as almost uniformly positive by economists. But efforts are needed to convey the message to politicians that whatever their views on trade, they should embrace open investment and the jobs it creates. In the United States, every $10 million of foreign direct investment creates 30 good jobs. 5.5 million Americans work for companies headquartered overseas, including many Singaporean companies. These foreign-supported workers comprise about 4% of our private workforce, but they account for 10% of our capital investment, 15% of our annual research and development, and 20% of our exports. And almost 40% of those foreign-sponsored jobs are in manufacturing, whereas less than 15% of the overall economy is in manufacturing. These are jobs for which we should be competing and fighting and not resisting through restrictive protectionist measures. But in spite of these striking statistics, the political response in the United States to investment cases such as CNOOC, the Chinese National Overseas Oil Company, in 2005, and Dubai Ports World in 2006, gave the impression that the United States was moving away from its traditional open investment policy. Between 2006 and 2008, a series of steps was taken to reinforce American openness to investment. Most importantly, a major revision to the law governing CFIUS, the Committee on Foreign Investment in the United States, which reviews cross-border investments that raise security issues and which drew considerable attention during Dubai Ports. Dubai Ports gave the impression that CFIUS reviews all cross-border transactions and blocks many. In fact, the United States averages over 10,000 mergers and acquisitions per year, of which roughly 2,000 are cross-border. CFIUS reviews on average fewer than 10% of these cases in any year, and its 20-year history has only blocked one investment. Just as we were starting to get out this open investment message in the summer of 2007, a new political storm started brewing. That was concern about sovereign wealth funds and whether they were investing for political advantage rather than commercial return. A nearly year-long effort headed by the International Monetary Fund and energized by the close cooperation among Singapore, Abu Dhabi, and the United States led to adoption last year of the Santiago Principles, named for the city, Santiago, Chile, in which they were issued. I would like to thank and compliment the leadership here in Singapore and the Finance Ministry, in Temasek, GIC, and elsewhere, who played a crucial role in this important effort. The potential furor has been averted for now on sovereign wealth funds. My personal view is that the next likely area of political concern will involve state-owned enterprises, who should thus strive to adhere to the Santiago Principles to the greatest extent possible. In any cross-border investment, whether the investor is official or private, it will be incumbent to perform effective due diligence around the public policy component of these deals. While not as amenable to numerical precision as business and financial due diligence, public policy analysis, regulatory, political risk, can be done with sufficient detail to ensure this vital component is neither over nor underestimated. Ladies and gentlemen, not only market operations and regulatory regimes have been found lacking during the current crisis, the world's financial architecture has shown that it too needs to reform to keep pace with the challenges and opportunities of the future. It is striking that so much of the global financial architecture is still based on the global economy that existed in the early decades following the Bretton Woods Conference in 1944. There have been in the last 10 to 15 years some important developments driven by the accelerating changes in the global economy. but the foundation upon which they were made still needs fundamental reform. First and foremost, the World Bank and International Monetary Fund need to be restructured to reflect the global economy of today and the future. This reform will require tough decisions on sensitive subjects like quota and voice. But without reform, these important institutions will not be in a position to play effectively their crucial role for economic development and financial stability. The G7 will continue in the near term to play a central role, increasingly, though, at the core of a G20 that will assume greater significance over time. The G20, as I mentioned earlier, was established after the Asian financial crisis of the late 1990s, but the group has really grown in importance in response to the current crisis. So, too, has the Financial Stability Forum discussed earlier. Like the Bretton Woods institutions, the G20 has particularly strong European representation, with the European Union as an institution the 20th member of the G20. In my view, we need also to link other important regional organizations to the work of the G20, including ASEAN, the Gulf Cooperation Council, the Council of the Americas, and the African Union. The resulting structure would be centered on the G20, with the G7 at its core, with connecting nodes to the IMF, World Bank, OECD, Financial Stability Forum, and important regional organizations, including the regional development banks. These are already existing organizations. They meet annually, and they have rotating chairs, but there's been very little dialogue, communication, or coordination between and among them, even though they very often are addressing the same issues of common concern. Therefore, I think there should also be an early meeting each year of the rotating chairs of the G7, the G20, and these important regional organizations to coordinate agenda items of common concern in the year ahead. These steps are not designed to be a zero-sum game among developed and emerging economies. This crisis has shown the need to act and respond on a comprehensive and timely global basis. Thus, future adjustments to the world's financial architecture should be made in an open and transparent manner, designed to raise the level of responsibility and participation of all economies. Ladies and gentlemen, we are living in the midst of a unique moment in the history of the global economy. Much has been done and much remains to be done, but we will come through this crisis. The strength of the recovery, however, will depend both on the actions we take individually and collectively, and also on our commitment to resisting protectionism and reforming the global financial architecture. I expect the strong relationship between Singapore and the United States to continue to play a significant role in our success, and thus it's my great pleasure to have been invited to join with you today. I'd like to thank you for your kind attention. I now look forward to your questions.
Thank you very much, Bob. I'm going to ask the first question. It may be the most difficult question. You know, I'm so glad that you made a very passionate statement against protectionism. I'm so glad you pointed out the virtues of foreign investment and what good they have done. But as you know, in the past, there used to be a very strong constituency supporting free trade, supporting free foreign investment. But that political constituency that used to support free trade and investment has progressively, over the years, shrunk and shrunk and shrunk, even in the United States and Europe. So who are going to be the real guardians of these principles of free trade and foreign investment that both you and I believe in, but the world doesn't?
My own view is the world instinctively understands that a global economy based on free trade, flexible exchange rates, and the free flow of capital across borders based on open investment policies is going to be the basis for a successful global economy. That message, however, I think first needs to be carried to an informed public, which is why it is great to have a forum like this in which to talk about this issue. But then I think it also needs to be brought to the attention of those in government, both in the executive and legislative branches of government responsible for negotiating and ultimately approving trade agreements, and those also responsible for considering and ultimately approving or disapproving protectionist measures. I've long thought that foreign companies employing those 5.5 million Americans have not understood the significant political leverage that gives them in carrying the open investment free trade message. And I think it would be good for every CEO of a foreign company who employs Americans to come to Washington once a year together with their plant managers, U.S. subsidiary leaders, and meet with the congressmen and senators from those states and districts where foreign capital allocation decisions are creating good American jobs. It's very interesting. It is understood at the state and local level in the United States. Mayors and governors are around the world all the time on trade missions and investment missions. For some reason, that message is not being carried through effectively in Washington, and I think in many other capitals. So, and part of that, again, on the trade side, I think, is because of quite a debate in the economist community about the jobs producing or jobs destroying effects of trade. On the investment side...
In the past, the economists agreed, right? Free trade was good, but now the economists are divided.
I would say, going back to Joseph Schumpeter's works on, creative destructionism, there was always an understanding that a free and open trading system would destroy jobs in some locations, but those would move elsewhere, and new, maybe higher tech, higher earning jobs would arise. I think that particularly as you move into times of crisis, as we are now, it's natural for people, I think, to try to hold on to what they have in a global economy that doesn't slow down in terms of its transitions, even as it slows down in terms of growth. So I think that the debate on free trade has become more complex since you and I first started working on the subject decades ago. Interestingly, though, I think that the thread on benefits of investment has remained pretty consistent, but just hasn't been carried, I think, in the starkly descriptive terms to keep people in capitals as it needs to be.
Great. Now we have about 30 minutes. Who would like to ask the first question? Please. You just stand up and identify yourself, and then not. Okay. After that, go ahead.
Mr. Kimmitt, my name is Jim Teague, and I have two brief questions. You've touched on the first one, and that question is ASEAN underrepresented in the G20? And if so, how could it be reconfigured to be more balanced? And my second question is, what is the single most important thing the G20 can do this week that would benefit not only Asia and the G20, but the G200?
One question on ASEAN, the other on G200.
Right. First, one of the reasons that I pushed as hard as I did for the meeting last November 15th to be held at the level of G20 was that the proposal from President Sarkozy and President Barroso to have a world summit would, in their view, have been done at a level of G13 or G14. So it would have been the G7 plus Brazil, Russia, India, China, South Africa, Mexico, and possibly Saudi Arabia. Well, first of all, there's no such structure. That would have been informal. The G20 was set up precisely to deal with financial crises 10 years ago, had met for 10 years at ministers' level, had an established deputies process, and look at the additional countries you pick up. You pick up Korea, you pick up Indonesia, you pick up Australia, you pick up Turkey and Argentina. So I think in the previous administration, that is the Clinton administration, previous to the Bush administration, which I served, I think they and their colleagues got the global representation of the G20 right. I think that was the right forum. I think there are arguments that if the G20 were established today, it might have included a different group of countries, but it still is pretty broadly representative. But if you take a look, there are some regions of the world not as well represented, and really in some cases they're sub-regions of the world. And if you take a look at Asia, there's pretty strong representation from Northeast Asia. Of course, Australia's there. And so you have this very important and dynamic region of ASEAN not formally represented. And I think the idea of this now G20 plus 6 format in which there is a node going out to ASEAN, I guess this year Thailand's in the rotating chair, I hope will be picked up on an ongoing basis, because I think that will ensure that that very important perspective is brought to bear. I think what they'll try to do at the G20 tomorrow is, again, try to converge to the extent possible on regulatory reform, agree on strengthening and significant new funding for the IMF. They'll have a lot of discussion about stimulus actions taken, probably some differences there, but President Obama said that the idea isn't to have a global stimulus package, but rather for each country to do what is appropriate for its citizens, both now and in the mid to long term. And then lastly, and I think the answer that I would give is, I think they need to reaffirm, but this time in action and not just words, the commitment that was made on November 15th to resist new protectionist measures at a time in which we're trying to recover and to create a sustainable recovery with momentum. I think there's, in my view, no doubt that there will be a strong statement condemning protectionism of any sort, and then I think the proof will be in the pudding afterward, because ultimately that free and open trading system will benefit, as you say, not just the members of the G20, but the global community much broader.
Young man.
Hi, Mr. Kimmitt. Considering the current financial turmoil in the United States...
You're from which school, by the way?
Hua Chong.
Hua Chong, okay.
Yeah. Considering the financial turmoil in the United States, do you consider that the United States is currently in the twilight period of its development? Meaning it's on its decline.
On a decline.
From an objective point of view.
Is the United States on a decline?
No. I think the United States has a tremendous ability to admit when mistakes have been made, to learn from those mistakes, and come through that process even stronger. We took a look a good year ago at the factors that brought us to this point, and we looked at all the market participants, from mortgage originators to commercial banks, investment banks, accountants, credit rating agencies, regulators, and investors. Nobody got a good mark. Complacency had set in across the board. As I said, the risk half of the risk-reward relationship was being largely ignored because people thought we were living in a world of almost unquenchable liquidity. We've learned a lot. We're going to, I think, come through this stronger, but not stronger on an inward-looking basis. The reason that President Obama is in London today, the reason President Bush so quickly agreed to the meeting in the G20 last year, was a recognition that we are just part of that global economic community, and we have to the extent that we can, find common courses of action. But I don't think we're on a decline. I think America's brightest days are still in front of it, but we have to learn from the mistakes of the past.
Next question. Yes, please, a lady, and then gentleman.
My name is Grace Chia. Just now you mentioned something about the concerted global stimulus, as it were. So in a very globalized world, U.S. currency is the global de facto currency. Do you see a place in the special drawing rights as suggested by China?
I think you're referring to the comments made by the Chinese Central Bank Governor Zhou Xiaotren. I took his remarks, and I know that the Obama administration took his remarks as an indication that China intends to play a more important role in the global economy and in that new global financial architecture. I think that's very welcome. I think also his reference to the SDRs, the special drawing rights in the IMF, signaled Chinese agreement that the IMF needs to be strengthened and capitalized at a higher level to deal with the challenges that we face today in many of the developed and developing countries. I think beyond that, I don't think there's any question that the U.S. dollar is going to remain the world's reserve currency, particularly at a time that we continue to comprise 25% of the global economy. President Obama and Secretary Geithner reaffirmed the U.S. commitment to a strong dollar policy last week. Ultimately, however, it's going to be how successful we are individually and collectively coming through this global crisis that will determine the course of the U.S. economy, and that's going to be the best indication of the dollar going forward.
Okay, please.
Augustine from Channel News Asia. Thank you, Ambassador. Mr. Kimmitt, I'm just picking up on the last question and trying to push you further. What's your frank assessment on the role for China and the yuan in terms of currencies between the U.S. dollar and the euro? Because there have been growing calls, and some countries are calling for the ability to be able to pay not in the dollar but in other currencies. And then just expanding on the topic about going beyond this. And so this seems to be the right time to be seriously looking at this issue again of the currencies.
You know, I really think it'd be better to leave to people currently in government to comment on currencies and particularly to comment on another country's currency. But what I would say, however, is that we recognize the important role that China plays in the global economy today and the even more important role that it will play in the future. That is why we at the U.S. Treasury Department initiated the Strategic Economic Dialogue with China back in 2006 to put our economic and financial discussions into a broader strategic framework, of which currency is a part, but not the only part of a broader discussion. And I think it is within that context that I would imagine the Obama administration would continue its bilateral dialogue with China. And of course, I think China will be a very important and constructive participant in the G20 meeting tomorrow.
Klaus? Yeah.
I'm Klaus Reckling, fellow at the Kuan Yew School. Two questions, one looking backward and one looking forward. Looking backward with hindsight, do you think to let Lehman Brothers go bankrupt in September last year was a mistake? And there's not a criticism, because I, like many others, supported at the time the idea that one of the banks had to go bankrupt, but obviously we didn't fully understand all the implications. So with hindsight, do you think one would act differently? And looking forward, we know that the US banking system is not working yet. Do you think that the Geithner plan that was announced last week will make it happen? Some people like Krugman, Stieglitz say banks, and Robini, the banks should be nationalized. That may be a minority view, but many and maybe a majority argues that more capital will be needed for these banks. But there's a concern that Congress might not be willing to agree to that. How do you see that problem?
I think looking back, it's quite clear that the Lehman bankruptcy had effects both in the United States and particularly globally that really tended to accelerate the crisis. I think it, again, in hindsight, would have been better had it been possible to save Lehman. The problem was the authorities that exist today did not exist at that time. Remember, in the case of Bear Stearns, a sale to a willing buyer was facilitated by the Federal Reserve. There were buyers looking at Lehman. At the end, though, there was no buyer, and the government at the time did not have the authority to take any steps beyond those that they had taken. Subsequently, new authorities were granted by the Congress, and now additional authorities have been requested so that when one deals with situations like that in the future, policymakers will have a broader array of legal authorities. Looking forward, I think that the program laid out by the Obama administration, by Secretary Geithner, is a very comprehensive program covering both the troubled assets, dealing with non-bank financial institutions that get into difficulty, and then looking at this regulatory reform. I think the capstone announcement last week of this public-private partnership around the troubled assets is very well considered. I think while there has been some criticism by the individuals you've mentioned, I think that it has generally been well received, including by those in the Congress. I thought some of the most important things that Secretary Geithner said last week were that it was also important for markets to play their part, that markets are better able to assess risk and to take the risk, and it's now time for markets to start performing again in concert with the government. So going to the very last part of your question, I thought his proposals were very well received in the Congress. I think the one that's going to take the longest time to get through the Congress is the regulatory reform. As you know, in the United States, we don't have a consolidated financial services authority. We have 5 or 6 different regulators, and we're also proposing now a new systemic regulator and also the possibility of regulating insurance at the federal level, at least on an optional basis. Right now we regulate insurance at the 50-state level. That's going to take some time to work through because we need to rationalize and better structure that system in the U.S. and then also coordinate well with regulators in key economies around the world. But I think that the overall shape of the program that he laid out is a good basis on which to proceed. It builds on things that were done in the Bush administration, but takes it beyond in some key areas.
Yeah. The gentleman in the fourth row, and then the ambassador of Brazil, and then the young man.
My name is Bert Horowitz, and I'm here visiting. And I'd like to ask a question that's related to one that was mentioned earlier. During your talk, you mentioned imbalances with respect to reward and risk, but indeed, the term imbalance was most frequently used with regard to the buildup of the current trade deficits and current trade surpluses. And among the things you mentioned that is important with respect to free trade is the importance of flexible exchange rates. So my question is, why during the Bush administration, during the initiative by Secretary Paulson with respect to the strategic initiative dialogue, there seemed to be no reluctance to talk to the Chinese with regard to the tremendous buildup of Chinese reserves due to their pegging of the exchange rate. On the other hand, when Secretary Geithner, or at that time Geithner, who was head of the Federal Reserve System, was being interviewed for the job, he emphasized that China was practicing currency manipulation. And subsequently, President Obama, after the appointment, called President Hu Jintao and apparently, let's say, apologized for it or said it wasn't really part of U.S. policy. Do you think that during the G20 meeting there will be a very important discussion about the fact that China has pegged its exchange rate with some minor adjustments for a long, long time? Thank you. Have to see where.
Again, I think the main discussion points for the G20 meeting tomorrow are the ones that I laid out about regulatory reform, IMF reform, stimulus, and the fight against protectionism. I think you're right, though, if you go back prior to the crisis, and if you take a look at global imbalances, it was believed that the Chinese currency, weak demand-led growth in Europe and Japan, and the low savings rates and the twin deficits in the United States were contributing to global imbalances. I would say that those are issues that are discussed both in bilateral and multilateral forums. I can't speak for current governments or what will happen at the G20, but I think the Chinese government has made very clear what its path is on the currency. I'll let the Obama administration speak for its views. We thought, again, that was an appropriate discussion, but again, in this broader context, that is the broader context of the strategic economic dialogue.
Ambassador, Brazil.
Thank you. My name is Paulo Soares. I'm the ambassador of Brazil in Singapore. Well, my question is quite a straightforward one. In an environment of, say, 1 or 2 years beyond the financial crisis, Mr. Robert Kimmitt, what would be your perceptions on the role to be played in the international economic arena by the emerging global economic players like Russia, like China, like India, and like Brazil? Thank you.
I think, Mr. Ambassador, the reason why the G20 forum was selected last fall and is continuing tomorrow as what appears to be the emerging body for not only crisis management, but perhaps laying the foundation for recovery, is its broader geographical representation, but particularly the presence of important emerging economies like Brazil, Russia, India, China, and others. I think that those countries play a very important role from a financial perspective, from a trade perspective, from an economic perspective. As you know, Brazil actually chaired the G20 last year at perhaps the most crucial year in the G20's history. President Lula da Silva was really the chair of the meeting that was hosted in Washington with President Bush. I thought that meeting, particularly for being put together for the first time ever at the leaders level with about a month to prepare, gave a very honest assessment of what brought us to the point that we were, laid out a good work plan for going forward, and I think tomorrow's meeting will take it a bit further. And I think that it was very important to have Brazil's leadership and chairmanship, just as it will be important next year when the G20 chair moves to Asia in Korea. So it's hard for me to think that we can any longer have the kind of broad-gauge discussions that are needed in some of the smaller forums like the G7. The G7 will remain important when you have the three largest economies, U.S., Japan, and Europe. They still are going to have a very important central role, as I said, but increasingly I think the G20 is going to play a role of growing importance and significance, and precisely because the countries that you mentioned and others play such an important role there.
Gentleman over there, and then the lady here.
Hi, good evening. My name is Alistair. I'm currently serving my national service here. I just have a question for you. In your speech, you mentioned as part of the new regulatory framework that the U.S. leaders and as well as other leaders would come with policies that would dampen and not amplify the business cycle. I mean, I'm assuming this means that the U.S. leadership has acknowledged that in the past there has been a point of time where the economy has experienced a tremendous sense of overvaluation of assets, or in another term, bubbles. But in its modern history, we've rarely actually seen the Fed or any other financial institution or body implement such a policy such a form of like contractionary policy, such as the lowering of interest rates. When they have, it seems that the remedies have come a little, too little and too late. So, and it's very easy to understand why such contractionary policies are unpopular at a time when everything seems very good, because nobody likes to, put an end to the party. So, I mean, based on your experience, having worked in the U.S. government, do you actually think it's politically possible to implement such policies in the future, given their unpopularity? And if so, what would be some examples of policies that are able to send the signals out to markets that, okay, there's a massive amount of overvaluation here, or the amount of risk taking is, it's exceeded what, market equilibrium levels. So what would be some policies that, would be viable in the future? Thank you.
I think I will defer on the monetary portion of your question about policy at the Fed. Historically, there's been quite a bit said and written recently by Alan Greenspan about his tenure, and I think Ben Bernanke has probably testified 50 times since the crisis began, and I think I'd let the Fed officials speak for themselves. But
Greenspan has said he's sorry, right? He said I was, what's the word? I was mistaken in my judgment of the market or something like that. Well, I forget the exact form of words, but he expressed regret about his policies.
I would say, knowing Alan, he was very precise in what he said. So I think I'll try not to paraphrase what he said. And knowing your ability to get on the internet very quickly, you'll have the exact quotation very quickly. On the pro-cyclicality point that you mentioned, however, which is a very important point, I think some of the proposals that Secretary Geithner put out last week about the increased capital requirements, greater transparency, particularly around private pools of capital, hedge funds especially above a certain amount, registering with the SEC, are intended to give that earlier warning system of bubbles or asset allocations that have become a bit skewed. And I think that's really among the things that they're looking to do with some of the existing regulatory authority that they have, but I think there's a belief that they need to extend that regulatory authority beyond banks in the financial institutions and beyond some of the instruments that have been used traditionally in the past that are becoming an ever more important part of finance in the future. So I think it's going to be a more open and transparent system in the United States, and I think that'll be a big part of the discussion tomorrow. And indeed, I think that's really been what President Sarkozy, Chancellor Merkel, and others have been talking about, exactly what is going to be form of that system so that we have better insights into the markets on a real-time basis to be able to anticipate these problems well in advance of the cycle.
Thank you. The lady over there. And then the gentleman here.
Good evening, sir. Just now you mentioned that the recent financial crisis emerged because of some of the mistakes that Americans have made. For example, the imbalance between risk and reward in the housing market. And do you think that Americans should act more responsibly in the process of spurring economic recovery rather than insisting on other developing countries, such as China, to pay the bill for Americans' fault, for example, through some recent irresponsible behavior that the American government has made, such as the drastic depreciation of U.S. currency? Thank you.
I think
that's a tough question.
No. Listen, every question's a fair question. I would say this, going back to the point I made earlier about some of the structural imbalances in the global economy. It's hard to remember, but before the crisis struck in 2007, the U.S. had been making very considerable progress on reducing its structural deficits, particularly its budget deficit. Our budget deficit in 2007 was down to, I think, 1.6 to 1.8 of GDP. If you remember that the Maastricht criterion was 3%, we thought that we were doing a fairly good job. And, of course, that's a measure of your deficit, of what you have to borrow and so forth. And I think one of the very interesting debates that's going on in the United States right now are the mid to long-term effects of deficits that would come out of some of the spending, both stimulus spending and the budget spending that have been put forward by the new administration. And some of those debates are even among Democrats themselves. So I think it is very important for us, even as we go through this time of crisis and look to come through it, to lay a solid foundation for recovery. We have to pay attention to the fact that we as Americans need to save more, that we need to be fiscally responsible, that we have to do our part in restructuring and lessening trade imbalances. I don't think we've ever shied away from that responsibility, because those are elements not only of a sound U.S. economy, but a sound global economy.
Okay, gentlemen over there. And then at the end, yeah, great.
Hi, Mr. Kimmitt. My name is Hua Qing, and I have a very simple question. Under the current economic downturn, how do you persuade the Asian countries to continue buying more U.S. government bonds? Thanks.
How do you persuade the Asian countries to buy more U.S. government bonds?
Oh, listen, ultimately, simple questions are always the ones you worry about the most, or last questions are always tough ones too. Listen, at the end of the day, whether they be Asian investors, private or public, or investors anywhere, including in the U.S., those are ultimately decisions that the investor needs to make. We are blessed in the United States with a very broad, very deep, very liquid debt market. Again, the goal over time would be to go to that market less and less as we get our budget deficit under control. But ultimately, I think that investors into the U.S. Treasury market are voting with some confidence about the mid to long-term prospects, not only of the U.S. economy, but the U.S. economy as part of the global economy. But ultimately, those decisions are decisions for the investors to make. I think it's our responsibility to run that market effectively and efficiently, and again, to take the steps that are necessary to get our economy and the global economy back on its feet.
Okay, we're running out of time, so a short, sharp question, if you don't mind. Yeah.
Yeah, no more simple ones, though.
All right. Observers have commented that the present economic and financial predicament began with the ill-omened collapse of the World Trade Center in the year 2000. And President George Bush delivered the coup de grace, or the economic coup de grace, by going to war, by entering Iraq and Afghanistan. And the destruction of the old prosperity, American old prosperity, since 1945 was complete and irrevocable. With the present positive and proactive program under President Obama, we all believe that the American economy will be resilient enough and will recover. A new age of prosperity in the 21st century would emerge. However,
excuse me,
yes,
sorry, I have to interrupt you. If you can just pose your question.
Yes, I pose the question now.
I really just get your question
yes,
now.
Yes. However, globalization has dictated a new world order, a multipolar world order, working together for world prosperity, with, of course, America still being the mainstay of the economic equilibrium. In other words, America may lose the hegemony among the emerging economic powers, such as China and India and Brazil, perhaps. Would you comment on that,
sorry.
please?
I have to stop you now.
Yes,
sorry.
I've ended.
I think we've got your point.
I've ended, sir. Would you comment, sir?
Sure. I'm going to agree on your last 2 points. I think the U.S. economy is diverse, it's flexible, and it's highly resilient. And I think it will return to strength. I think the steps taken by the Obama administration are very important steps toward that goal, which is beneficial for the U.S. and for the global economy. At the same time, the reason that we are as actively engaged in forums throughout the world, G7, G20, APEC, and others, is we would like to see other economies also succeed, both for the people of their own countries, but because it benefits us too. And so if you're suggesting that there is going to be growing strength in emerging economies, I think that's great, because I don't see it as a zero-sum game with the United States. I see it not as an either-or, but a both-and proposition where that rising tide will raise all the economies. I think that would be to our great advantage. And I wish every country in the G7, in the G20 and beyond, the greatest of success, because that's going to add to global success as well as our success. I just don't think any of us, including the United States, can do it on our own. We have to do it in close collaboration with others.
Let me end with 2 very simple questions. Okay? First one, why are you so confident that this crisis will end? And secondly, when will it end?
I am confident just because I have the utmost confidence in precisely what the last commentator said about the resilience of the U.S. economy. As I said, we are very good at being quite honest about mistakes that were made, learning from those mistakes, and coming through the process better. And as I look back to recessions that I've lived through, like the early 80s, if I look at the historical record, we've come through tough times before. We'll come through this. I think the difference is, and again going to the last point that was made, we've never had a crisis this global with the globe this interconnected. So we cannot come through it by ourselves. We have to come through it together, which is why tomorrow's meeting and meetings of that sort are going to be ever more important, not just as gatherings to talk, not just as photo opportunities, but as laying the foundation for the work that governments must do to spur markets to do what markets must do. Someone once said that economic forecasts tell you a lot more about the forecaster than the economics. I don't have really a personal view. If I take a look at the weight of economic analysis in the United States, I think most people believe that we will start to come out of the difficulty by the end of this year, and we'll start to see recovery next year. That's for the U.S. I think we will see some parts of the globe recover quicker, some perhaps a little bit slower. But I think overall, if we do a good job of working closely together, even though we'll be taking some different steps in different economies, I would think that the global picture over the next number of years will get steadily brighter.
Good. I think that's a very good note to end on. Things are going to get better. Relax. And thank you very much.
Don't relax yet.
Thank you.